There is a 3-digit number that follows you everywhere. It determines whether you can rent an apartment, whether your car loan costs you $200 a month or $380 a month, whether you get the mortgage that lets you buy a home or the rejection letter that sends you back to your landlord. In some states, it determines whether you get the job. In some industries, it determines whether you get the license. It is the single most consequential number in the average American's financial life. And almost nobody understands where it comes from, who calculates it, what it actually measures, or why the behaviors it rewards are the exact behaviors that make lenders the most money. The credit score. Specifically, the FICO score, a number invented by a private company, calculated using a proprietary formula that is legally protected as a trade secret, that you are required to have, cannot opt out of, cannot fully understand, and are penalized for ignoring. And by the end of this video, you are going to understand why the credit score system is not a neutral measurement tool. It is an engineered behavioral system designed to produce a specific kind of consumer, not a financially healthy consumer, not a debt-free, savings, rich, financially independent consumer, a leveraged consumer, a perpetually borrowing, perpetually repaying, perpetually profitable to lenders consumer. And the genius of it is that it made you want to be that consumer by convincing you that being that consumer means you are responsible. Let's start with the origin story because it is more recent than most people realize. Before 1989, there was no such thing as a standardized credit score. Lenders made credit decisions based on their own internal criteria, local knowledge, relationships, and frankly, a significant amount of discrimination against women, minorities, and anyone a loan officer personally disliked. The system was inconsistent, biased, and genuinely unfair in ways that caused real harm to real people. Fair Isaac Corporation, founded by engineer Bill Fair and mathematician Earl Isaac in 1956, had been developing statistical models for credit risk assessment for decades. In 1989, they released the FICO score, a standardized algorithm that promised to remove human bias from lending decisions by replacing subjective judgment with objective mathematics. The pitch was compelling, universal, neutral, mathematical. Your number, your responsibility, earn it. And compared to the system it replaced, which included loan officers denying women credit simply because they were women, the FICO score was genuinely an improvement. But here is what got quietly embedded in the improvement. The formula was designed by a company that sells its scoring system to lenders. Fair Isaac's customers are not you. You do not pay Fair Isaac anything. Fair Isaac's customers are the banks, the credit card companies, the auto lenders, and the mortgage originators who pay for access to your score so they can make lending decisions. The formula was designed to serve the needs of those customers. And what lenders need is not a measurement of your financial health. What lenders need is a prediction of your future borrowing behavior. Specifically, will this person borrow money and repay it with interest, reliably enough, and for long enough to be profitable? Those are different questions. A person with zero debt, a full emergency fund, 6 months of expenses and savings, and no credit accounts is financially healthy by almost any objective measure. The FICO score for that person, potentially unscorable, or in the low 600s subprime territory, because the formula cannot measure savings, cannot measure net worth, cannot measure income. It measures your relationship with debt, specifically how obediently you have managed borrowed money over time. Let's break down the actual formula, because this is where the design intent becomes visible. FICO scores are calculated from 5 categories. Payment history, 35% of your score, amounts owed, meaning your credit utilization, 30%. Length of credit history, 15%. New credit inquiries, 10%. Credit mix, meaning the variety of debt types you carry, 10%. Payment history and amounts owed together account for 65% of your score, which sounds reasonable until you notice that amounts owed does not mean total debt. It means your credit utilization ratio, the percentage of your available revolving credit that you are currently using. And the formula rewards you for carrying a balance, not a zero balance, not paying everything off every month. The sweet spot the algorithm rewards is somewhere around 1 to 10% utilization, which means the formula is specifically structured to give you the best score, not when you owe nothing, but when you consistently owe something, repay it reliably, and keep borrowing again. The ideal FICO consumer is not debt-free. The ideal FICO consumer is perpetually, manageably indebted. Now let's look at length of credit history, because this one is where the trap really locks in. 15% of your score is based on how long your credit accounts have been open. Specifically, the age of your oldest account, the age of your newest account, and the average age of all accounts. Older accounts mean a higher score. Closing old accounts hurts your score. Opening new accounts lowers the average age and temporarily hurts your score, which means the system penalizes you for closing a credit card you no longer use and no longer need. The financially rational behavior, eliminating an account you have no use for to simplify your finances, damages the number that determines your borrowing costs for the next 7 years. And credit mix, that final 10%, rewards you for carrying multiple types of debt simultaneously. A credit card, an auto loan, a mortgage, a personal loan. Diverse debt is rewarded. No debt is penalized. The formula does not say this out loud. It does not have to. It just quietly produces lower scores for people who choose to not carry multiple forms of debt simultaneously, and higher scores for people who are actively profitable to multiple categories of lenders at once. Now let's talk about the error problem, because this is where the abstract becomes genuinely costly. The Federal Trade Commission conducted a study in 2013 and found that approximately 25% of consumers had at least one error in their credit reports significant enough to affect their credit score. 1 in 4 Americans, paying higher interest rates, being denied credit, being rejected for apartments, because of inaccurate information in a report maintained by a private company they never hired, reporting data from lenders they may have had disputes with, using a formula they are not allowed to examine. And the process for disputing errors is, in the tradition of every system we have discussed on this channel, designed to exhaust the person with the legitimate complaint. You dispute the error with the credit bureau. The bureau sends the dispute to the original creditor to verify. The creditor, the same entity that reported the error, verifies their own data. Usually, they confirm it. You dispute again. You provide documentation. The bureau has 30 days to investigate. The investigation frequently consists of the bureau asking the creditor to re-verify. The creditor re-verifies, the error stays. The Consumer Financial Protection Bureau received approximately 700,000 credit reporting complaints in 2023. More complaints than any other product category they oversee. And the 3 companies receiving those complaints, Equifax, Experian, and TransUnion, are private corporations maintaining financial dossiers on approximately 220 million Americans without those Americans' affirmative consent, without a right to opt out, and with a dispute resolution process that multiple federal investigations have described as inadequate, understaffed, and structurally biased toward the data furnisher. In 2017, Equifax suffered a data breach that exposed the social security numbers, birth dates, addresses, and credit information of approximately 147 million Americans, nearly half the country. One company, one breach. The penalty Equifax ultimately paid settled at approximately $575 million. Divided across 147 million affected people, that is roughly $3.91 per person for having their most sensitive financial information exposed to criminals through a company's negligence. A company they never chose to do business with. A company they had no way to opt out of. A company that continued operating, continued collecting data, continued selling scores to lenders, and continued generating revenue approximately 18 months after the breach, while affected Americans spent years monitoring for identity theft. Now, let's meet someone who lived the cost of this system. Meet Marcus. Marcus is 29. Marcus is good with money. He has never carried a credit card balance. He saves 20% of his income. He has no student loans. He drives a used car he bought in cash. He has $18,000 in an emergency fund. By every measure of actual financial health, Marcus is doing better than approximately 80% of his peers. Marcus's credit score is 641. Because Marcus has one credit card he pays in full, every month, no installment loans, no mortgage, and a credit history of only 4 years, because he did not get a card until he was 25. Marcus wants to buy a condo. He goes to a lender. He is offered a mortgage at a rate 1.4 percentage points higher than the rate offered to a borrower with a 760 score. On a $280,000 mortgage over 30 years, that 1.4 point rate difference costs Marcus approximately $78,000 in additional interest. Not because Marcus is a worse credit risk than the 760 borrower. Marcus has no debt and $18,000 in savings. He is almost certainly a better credit risk, but the formula does not measure creditworthiness in any meaningful sense. It measures credit history. And Marcus's history of responsibly not borrowing money is being penalized at a cost of $78,000 paid to a lender over 30 years for the crime of being financially responsible in the wrong way. This is not a bug in the system. It is the output the system was designed to produce. A person who avoids debt gets penalized. A person who manages debt gets rewarded. The reward is better access to more debt at lower rates, which they are then expected to take on, which generates more profit for the lenders who pay fair Isaac for the scores that recommended the lending. The loop is closed. The incentives are aligned. Just not with you. Now let's be precise about what we are not saying. Credit scores, for all their structural problems, did replace a system that was more arbitrary and more discriminatory. Having a standardized, consistent metric did expand access to credit for populations that were previously denied based on factors that had nothing to do with repayment ability. That is real and genuinely matters. And for people who are actively borrowing, managing a credit score is a practical reality that affects real costs in real dollars. Understanding it and working within it is not defeat. It is survival. The moves that actually improve your score within the current system: own, pay everything on time, every time. Payment history is 35% of your score, and it is the most controllable variable. 2. Keep credit utilization below 10% on revolving accounts. Not 0, below 10%. 3. Do not close old accounts, even if you do not use them. Age matters, and closing accounts shortens your history. 4. Dispute errors immediately and in writing through certified mail, not through the online portal, because written disputes create a paper trail that online submissions often do not. 5. If you have thin credit history, a secured credit card or a credit builder loan used and paid consistently over 12 to 18 months can move a score meaningfully without requiring you to carry debt. These are the rules of the game as it currently exists. Playing by them is rational, but playing by them while understanding that the rules were written by the people who profit from your compliance is a different thing than believing the score is an honest measurement of your financial character. It is not measuring your financial character. It is measuring your value as a borrower to the lending industry. Those two things are not the same. They have never been the same. And the fact that an entire generation grew up believing they were the same is the most successful marketing achievement in the history of American consumer finance. So drop your take in the comments. Do you think the credit score system is flawed, but fundamentally fair, and the solution is just to learn to play the game better? B, a private company's trade secret formula should not have this much power over this many people's financial lives. Or C, you just checked your score while watching this, and now you have questions you did not have 20 minutes ago. Leave it below. Because the number only has power when nobody explains exactly whose interests it was designed to serve.